So updated dealer news with regards to Canada. Last time I brought attention saying this time I'll talk to you about what has been driving up used car prices during peak COVID. And surprise, surprise, demand is one portion, but it's not consumption demand in some sense. It's a very odd sense. So all right, so we'll go deep into this first. All right, so what we got during peak of COVID, Portland, was news that silicon chips were in short supply. So what you had was news channels 24/7 telling everyone COVID is here, there's not enough chips. It's free marketing, basically, for what? Dealers. So as a dealer, when you hear that, imagine you as a businessman, any proper business person saying, hey, there's a supply shortage of my product, I'm going to stockpile and I'm going to increase the price for. That's what, let's just say, one deviation would go. So the first sensical businessman would go with that. Oh, okay, there's a supply shortage. I guess I'll stockpile a bit more. Well, because they started stockpiling, it caused a ramp up in demand. And low interest rates allowed for customers to be able to pay more for the car. So basically, they were able to get larger loan amounts. So it kind of, these two are like the perfect storm to start driving up the prices for used cars. But what wasn't really mentioned was the influx of new dealerships. When interest rates are very low, capitalization becomes very cheap. Like there's cheap money everywhere. But what you get is a lot of people seeing like these industries are going to explode because of inflation. So what happened was a lot more players got into the game. A lot more, not just new dealers were being set up, like a lot of new dealers were being set up. The last 2 years probably has been more new dealers than ever before because of just the pure amount of money going into it. Like you had the free news of the TV outlet telling everyone there's supply shortage, car prices are going up. So the customer's mentality is like, oh, car prices are going up, I guess I'm going to go buy a car, right? You go to the dealers also has that same mentality. Hey, the TV channels are saying supply shortage, man. They come in and say, I don't need to sell it to you. I could just increase the price. Do you want it or not? I have a dozen people who want it. But meanwhile, what they're not telling you, they're also turn around on wholesale, buying as many cars as they can at no matter what prices. Just for fair context, I need to do a fair context on this. During COVID, like during the panic of the 2019 and 2020 COVID, there were a bunch of dealers who were caught upside down. So there's a bunch of dealers who just panicked and sold everything. Like they were just like, oh, the market's done, everything's over, sell everything. Those guys were caught upside down because of this, because of the inflationary drive, low interest rates. So those guys really did have no inventory. So those are the dealers who you're going, oh, it's empty. Everything's empty here. There's nothing to be sold. Yeah, those guys were caught upside down because they panic sold. Like it's kind of like stocks. You're like, the market's going down. You short, sell everything, right? And then market rallies and you go like, oh no, right? So they're the ones who were caught upside down. They were caught with their pants down. Meanwhile, the dealers who experienced this before recognized that this cycle is about to happen. And what they started to do is stockpile. They started stockpiling a lot of cars. So what you got was a ramp up of demand, very quick ramp up of demand when the market was all-time low. TV outlets talking about supply shortage because COVID is affecting supply chains and just-in-time delivery systems and manufacturing. So you had a reduced supply incoming in, and then you had the dealers who knew the game start buying up cars in the dozens. They're starting to drive up cars. So you had a growing demand and a diminishing supply, thus higher prices. But we're just talking wholesale, we're not talking retail yet. So retail gets a shaft. Like, so sad, retail has to pay everything at the end. So the dealers start ramping up the price. So what happened is, you give it about a year. Now the dealers, like the ones that panic sold, goes like, oh, okay, the market's not ending. It's not Armageddon. Oh my God, the market's actually super strong. Low interest rates. The banks are willing to loan out so much money to people to buy these cars. I have to go and buy a car. Oh, there's a supply shortage. I can't order any more cars. I can't order that many cars from the manufacturing. Why? Because during the panic selling, like where we actually kind of ruined our relationship with manufacturers, those guys kept buying. So if you're a manufacturer, you go like, yeah, of course I'm going to help the ones who've been buying to me during the peak of COVID where everyone is canceling deals. So they already bought everything. They already bought all the allocations. You're not getting anything. So what happened was those dealers then had to look out into the wholesale market and start buying up more. And you could easily see how it's just demand ramping up demand, right? But this used car market is ever shrinking. But that's just tier 2. That's still nothing. Now the real stories are coming in. when interest rates are low, it also gives room for supposedly innovation. It's just profitless innovation. So what you got were new dealerships coming into the field because interest rates were low. New people seize the industry. This is a booming industry. They get into the dealer market. Or dealers who are working at companies that were laid off during the panic, they start out as like, I'm a dealer. I knew what I was doing. They go open a dealership. Why? Because banks were giving out people at low interest rates. This is the same concept that led to the housing prices skyrocketing. Exact same. I can imagine there's actually same players in that field, but that's a different story, okay? So what you got there is like now the second deviation is like, all right, the second deviation, new players coming in. What you also didn't get was new tech companies coming in, because when interest rates are low, tech companies are going to come over and revolutionize everything because it's cheap money. So during the last 2 years, you probably heard of the big spawn of the big three companies. Well, in Canada in particular, that's Drive, Canada. You've probably seen their ads everywhere. Clutch, you've probably seen their ads everywhere. And one of them, probably less quieter, Herman Gregor. I'm not too sure about this one, but it is an online company. Same exact business model as the other two. But this one's more based in Quebec. You have these three massive guys coming in, armed up to the teeth with venture capital money, which is like millions and millions, who don't really give a damn about losing money because kind of like Netflix, it's all about growth. In the industry where cash is cheap, growth is number one. So these are the guys who really drove up even more demand than ever before. Like Clutch at the peak was like driving up demand just in the Ontario area alone. They went out and purchased over 1,300 cars. Just imagine that demand out of nowhere just spawned it. I have cheap money, millions and millions of dollars. Let's go. And you're buying up cars too. So imagine tier 3 or deviation 3 or whatever, deviation 3, deviation 2, deviation 1. So the people in the third tier, the tech companies, the easy capital money that just came in the industry because they know this is a growing industry because cheap cash, fighting the tier 2, who are the dealers who are caught upside down for the same cars, who are all competing against tier 1, who are the guys who knew what was happening and they were buying up cars. So now you saw, oh, this is a lot of demand buying these cars. And then and then all that amplified by the news saying supply shortage, and now amplified back by after COVID policies. COVID's now settling down. Work from home's kind of ending, which is we'll talk about 2021, 2022. There's a mixed, like the return to office, workplace was coming back bit by bit. People still work from home, but it's a mix. Sorry about that. It's a mix. It's a mixed system. So people who sold their cars during pre-COVID now is like, oh, we do need a car again. Now they're coming back into the market. Okay, they are armed with low interest rates, armed to the teeth with banks with low interest rates because that's what the government did with their policies, right? Well, when you have low interest rates, kind of like the housing market, you could start buying pretty expensive cars very quickly. So boom, bang, then you got people were paying above MSRP for cars. The dealers recognized this and they saw it as a dealer, it's sad to say, we are profit driven. If you're a profit driven business and you know, hey, there's a supply shortage, there's not that many cars, these new customers coming in have there's a low interest rate. They're liquid because banks and anything's willing to throw money at them to buy anything. So they start buying cars for really outrageous sums of money. Like it really was outrageous. People were paying over sticker just to get cars. New cars were fetching the top dollar, and then used cars were all on average going up. And all this is funded by a low interest rate environment, by banks. Now, blink of an eye, let's go all the way to today when the interest rates have finally started coming back up. Well, actually, no, let's go a little bit before that. With regards to Clutch and Drive, which is the topic of this conversation, well, I sold a lot of cars as a dealer. I sold a lot of cars to Clutch and Drive, like a lot of cars, because they were actively buying. So me as a dealer, like I'm selling cars or whatever. I just get things in and I move it out. That's my job. I trade up and down, doesn't matter in the market. But I noticed the players. So when I notice the players who are buying my cars for their inventory, for their wholesale side, I pay attention if they're making profits or not, just to see what's reasonable in the market to try to anticipate where the market goes. And it was very funny when they were buying my cars because I looked at it as like, wow, they're like the whole, like there's talks of wholesale equaling that of retail pricing, which is crazy. Wholesale getting into retail is like, where's the margin for the dealers, right? But it was happening. Regardless, I was wholesaling cars at almost retail level, and I was scratching my head. Like, I'm happy. I don't mind. My customer gets a happy deal. They get more equity out of their cars, which a lot of people were doing because they heard this too, right? And then I was selling it at peak value to dealers. I didn't really enjoy the fact of trying to sell these cars to people because I knew it really felt like I'm tying them down to a debt trap, like, you know what it is. But luckily cars are fixed rate. It's not like variable, unlike the mortgages. If mortgage is variable, these guys are really upside down on these cars. But anyways, we'll move on ahead a little bit and then just to see. So I looked at the models of Clutch and Drive. They are what we call a venture capitalistic, well, what I would call, I'm not termed particular in this phase, a venture capitalistic tech company. They're more tech company over than a dealership. They're a disguised dealership. Like, they're a tech company disguised as a dealership. That's probably the easiest way. It's like they're fancied up with a fancy website, fancied up with a fancy model saying we'll deliver cars to your house. Sounds good, sounds great, sounds innovative. That's the term. But from my understanding of these industries, of these venture capitalist industries, they're built on preying, I don't want to say preying, but like they're built on venture capital. What does that mean is a bunch of people pull in money into a venture capitalistic company who then finds investments that could be the next Netflix, right? The next Tesla, the next big thing. They don't know what, they just fling their money at them and then they take it and they find the companies that have innovative ideas. Oh, this looks like innovative, it could change the world, has a good story, has a good team. Then they fund it, and then they go through Series A, B, C, like, you know, it just
hoping something works.
Yeah, it just opens, and well, here's the story that goes up. They get their Series A funding. You're a company, you come in as a team, you get a good idea. They fund you. They fund you with money. They say, all right, they fund you with a small amount of money to see if you grow or not. And then they tell the early investors that, hey, you have Series A in this company. And what they do is tell this company, focus on growth only, to show that you're growing, to show customer, it does not matter you're losing money or not, just grow. Like, if you show that you have 100x growth, it's like your Series B are going to be worth more. And the venture capitalists are really incentivized to do that. So,
and this is what happened with Clutch.
Well, it happens with Clutch. It happens with, honestly, a lot of businesses that we see today that, like, the end goal on their side is IPO and then sell their stuff to the stock market. Okay, so then when you guys Series B, they got even more money, but then as you're just, when I explain this model to you, you then realize something. It's like, okay, so they're throwing all their money at marketing, they're throwing all their money at everything, but then is the model overall profitable or not, right? So, like on my particular case, as I said earlier, I was selling to Clutch and I looked at their model. They're not profitable. It's absolutely crazy, but like, for the price I sell my cars to them, they're not profitable at all. It's like, it was a head scratcher to realize, what are they doing? And then, like, you came to ultimate realization. Like, I was calling it months ago, like, not even like a year ago. Honestly, at the peak of COVID, it's like, there's crazy money. It's just crazy money out there, crazy ideas. Everyone is going crazy big and trying to break something. And then you see something like Clutch and you go like, wow, they're very big. They're growing very fast. They want to be the next Carvana, which is the state's equivalent. And never mind, if you look at the stock of Carvana, the US, that thing's down 99% from their peak. Or, okay, 90%, they recovered a little bit. But yeah, that thing is taking a hard hammer. But during COVID, they skyrocketed. They were like kings. And now they're back to, like, not peasants, but they're back down to reality. But they cost investors a lot of money. Yeah. So with Clutch and all that, I was looking at their model, and it's like, it just really didn't make any sense. It didn't make any sense on their model. So I was calling out there, like, oh, these companies might go bankrupt when the interest rate environment starts peaking, when we start reversing from that. What that means is, when interest rates going up, capital gets tightened, right? So people can't, first it'll hit the consumers, then it'll hit the businesses. It'll hit everyone. So what we experience is, during the last, 9 months? Almost a year. Yeah, we almost have a year of hikings. The interest rate went from 0%, honestly, the bottom, all the way up to 5? Well, right now Canada is probably around approximately 5%. The target by US was 5.25. That was like straight up in interest rates. And you would see the demand destruction. So now we go back to the past, you see all the demand building up, for cars, amplified by news, amplified by new dealers, new businesses, so much demand, all funded by low interest rates. It's all funded by low interest rates. Now, on the reverse of that, interest rates are coming up. So the banks have to look at this again. As interest rates go up, what's going to happen? First off, the consumer can't buy these cars at these high valuations anymore. Because why? Their monthly loan rate's gone up. The monthly lease rate has gone up dramatically, much like the mortgages. Much like the mortgage, it's literally gone up. Like today, if you had to get a secondhand lease car, it was 9.99%. That's crazy. That's a used lease pricing. If you get a manufactured lease price, it's 6.99, which is still also crazy. From the days just half a year ago of 1% for certain cars, it's gone up to 6.99. It's drastic.
And how has this affected companies like Clutch?
Well, okay, so as continuation, as the interest rates drive up, first you have the consumer not being able to purchase cars at these price points anymore. Second point is that you have the dealerships who had low interest rates. They are now suffering a high interest rate loans because they have to take loans to buy the cars. So they lose demand because, well, they really can't afford that many more anymore, right? And then they have to realize what inventory they have on their hand. And they probably have to, like Clutch, have to consider, should I let some inventory go? Because the banks get concerned too. And then because there's less demand from the consumers, less demand from the dealerships, because there's a little concern on foresight, then comes the capital loans. Companies that run on heavy margin loans from banks who were stemmed up for the last 2 years now face a higher interest rate. So it essentially means prove your model. You need to have profit. You need to be able to cover your costs at least. Clutch at the peak of the market where low interest rates are ever, it looked like they weren't making that much money. And now you're telling me the costs go up 5x, would they make more money? No. So they started losing money. And during the last span of the last couple months, I would say on Clutch particular end, not bashing on Clutch, it's just a cycle. Their peak of 1,450 cars here dropped to 356. I saw that. They were dropping, they were selling it. They were selling their cars quickly to recoup as whatever capital they can. And then that's on Clutch's end. And Drive definitely experienced the same concerns too. But Drive probably continued on because Drive is much bigger than Clutch. I think so. I need to confirm that. Don't scratch that part. But Drive and Clutch are very similar in their aspects as a business. So as interest rates go up, they started experiencing a lower demand. People aren't buying their cars anymore. And what that ultimately led to is decrease in valuation for cars. Car valuation goes down, affects the valuation of the business. So Clutch, let's just say with 300 cars, even with 300, 400 cars, Drive with their amount of cars, they just experience a valuation crush of their inventory. To that, instead of breaking even on cars, they're losing a lot. So now you just, heads up, if you sign up with Clutch and Drive for the newsletter, they're going to keep mailing you, say, hey, it's under market value. Hey, they're trying to get you to buy their car. But ultimately now, I guess it's finally knocked on wood because it was just released recently in news. Drive has been driven up to not bankruptcy, but Chapter 11. So a restructuring and then a notice to their debt creditors. Basically saying, yeah, if we don't do anything now, we will go bankrupt sooner or later. So yeah, that's a very big news. Clutch laid off 65% of their employees recently. So they're going into hardcore conservative mode to try to see can they weather the storm of high interest rates right now. But was calling it, not praising them going down, because as a dealer, even I'm affected, right? Because I would see this, I just lost a huge demand customer, technically. They are customers to us, right? So you just see this market just completely turn 180. As quickly it goes up, as quickly it could go down right now, right? And if Drive's recent bankruptcy declaration, well, they're not bankrupt, but Chapter 11 restructuring. It's a really big sign to see it's a sign of things to come. So yeah, you can probably witness the news everywhere now. Drive finally finalized their Chapter 11 restructuring. They're laying off a good percentage of their workforce, and they're recuperating as much money, and they're also trying to consolidate debt with their creditors. And it's interesting, and they're getting out of the used car sales too. So that's pretty massive too. Clutch already moved out of Eastern Canada used car sales. That's supposedly on their site. Need to verify that, but they themselves are under pain as well. And I foresee, as a continuation, this is just one of the first signs too. It's not the end. There's still more. Like during the last 2 years, as I said, a lot of new dealers were formed. A lot of new dealers, when they get a $2 million credit line or floor plan to buy cars at low interest rates, they go crazy too. Those guys are also in trouble too.
In this case, for dealers, it does look not so good for them.
Yeah, it's pretty.
For consumers, though, how does it look for them? Is it a little bit brighter than even a few months ago, that they can get a car for maybe a little bit less?
Well, based on so on the podcast last time I've spoken about, it's sorry, the call just knocked me off. Can you repeat that again?
Yeah. So does this look like maybe consumers can pick up a car for a little bit cheaper than maybe even 3-4 months ago?
Well, okay, so the discussion is with regards in this case as a deflationary effect on vehicles. So deflationary as cars no longer go up in price, and then they're starting to steadily find an area where the price point will lay. Yeah, and maybe will it go down in price too? That is a good topic. Technically, yes. As long as people hold on right now, because with interest rates increasing, it basically means there's more value in holding cash than holding anything else. There's more value in holding cash because the government themselves are increasing interest rates. So if you hold, the other topic at the end is, it's always crazy, but here's a factor. Cars are supposed to be a depreciating asset. During the last 2 years, it was not. It was an appreciating asset. It made absolutely no sense. So we're kind of, in a sense, returning to normalcies at this moment in time. So vehicles, I expect to be taking a big, they're going to start dropping in price, and they already pretty much have recently. They've studied the reduced in price, especially mindsets of certain of more luxury cars. Vehicles between 50,000 above to 100,000 has completely seen an evaporation of demand, and they are correcting in price. But the side note is, it's a mess too, because cheaper cars are experiencing a boom in price. So what I mean by that is, last time I hinted a little bit, is there's something going on with the market that's causing concern. So Civics, for example, just brand new Honda Civics, they're reliable cars. It might have something to do with the consumer's mentality shifting. They might be shifting because they see a recession, they still have some cash in the bank kind of thing, and they're deciding to buy economical cars. They're just yeah, no more BMW, no more Mercedes-Benz. I just need a car that'll tank the next few years, that's reliable, cheap, and economical. That's what I would suspect that the demand market would be like, right? So what I recently witnessed were a small micro bubble occurring with economical cars. Honda Civics, Toyotas, they're experiencing a micro boom while everything's busting. What I mean by that is a brand new Civic off the ground Civic Sport. MSRP is $32K, which that in itself is crazy. It's crazy high, but manufacturer adjusted to inflation, and that's what they're selling at. So that's the new inflated price out of it. But if I tell you wholesale for those cars, bring the car up to 39,000 to almost 40,000, 37,000, and selling consistently between dealers, there's something happening there, which is a concern, which is an honest concern of another micro bubble that's happening here. Instead of the big bubble, it's now collapsing and congregating at the smaller bubble, which is the more economical end. So we're just seeing a price correction to the likes that we've never seen before. It's just the market's so confused on what to do with things.
So they've just moved from like one place and now they're in like a
Oh,
lower
it's
category.
yeah, it's from the luxury side and it's moved to the lower side. But the whole Honda situation is a different story. That's a different podcast because the whole Toyota economical cars, it's a derivative of what happened with the supply shortage chain. It's a derivative of it, honestly. That's another podcast for another time because it's a big discussion, that thing. But what I could note is I sense a micro bubbling occurring with those vehicles. Not saying everyone to be careful with it. It's just, well, I would warn to be careful of paying things over MSRP, paying things above dealer sticker. But that's something to be paid attention to. If the overall question is, will we start noticing car prices correcting? My answer is, in my feeling, yeah. I fully expect cars to be continuously going down in price because demand is drying up probably much quicker because these consumers have other expenses rather than cars. Honestly, in a recession, the first thing to go is probably the car before the house. I would rather pay my mortgage than pay the car, right? So the car goes. And I'm pretty sure the banks are getting really concerned about their debt levels because they financed most of this. So I probably would see banks correcting as well, quite drastically, or making a lot of losses.
And I think that's something we could probably leave off at.
Yeah, it's another
to look forward to for next time.
Yeah, it's another conversation point. Yeah, it's another conversation point. It's funny how the automotive industry is driven up by prices, by interest rates, dramatically interest rates as well. We live and die by the interest rate, and honestly, the economy. In my opinion, we live and die by it, and live and die by expectations and belief in that interest rate. But yeah, there's other topics ahead as well, which discuss what we see in the future, what I will assume would be the future. It might not be true, it's true. What I see in the future of the automotive industry, and a lot of dealers probably see that as well. The next few years are definitely going to be different. It's going to be really different to what we're experiencing now, which also may give some reasoning why there's micro bubbles happening. But overall, as long as you can remain liquid during these periods, like your cash, you're good, you're sustainable, you have a business model that's proved profitable, and then you're able to sustain this after COVID interest rate hike environment and recessionary environment, you're good. So the real talk is the next 5 years, if recession is coming, and recession should be here, the next 5 years, if you could build a business model and you could prove utility, prove profit, prove that you're profitable and you're able to provide a utility function to society, you're good to go. Because after this recessionary period, then we're going back to the boom when the interest rates are cut back down again. Yeah, I guess we could end it off there.